Hi, my name is George Hadger, and today I'm going to talk a little bit about earnings growth and returns for companies. I'm going to start by asking you whether a company that is able to grow its earnings 20% every year is a good company or not. Your initial thoughts might be that that is a strong level of growth, therefore it's likely that this is a high quality business. In fact, the answer as to whether this is a good company is only a maybe. Just looking at earnings growth in isolation is simply not enough to determine whether a company is good or bad. What it fails to consider is the level of capital required to achieve this growth. The company growing earnings by 20% per year was producing incremental earnings of $2 million, but was requiring $100 million of incremental capital to achieve these earnings, and that is in fact a poor business. Its return on incremental capital is a paltry 2% and most likely lower than its cost of capital. This leads us to consider the three broad categories of businesses in light of this framework of returns on capital and reinvestment requirements. The first category refers to high return on capital businesses with low capital requirements. The second category refers to businesses that require capital to grow but are still able to earn a decent return on that incremental capital. And the third category is businesses that require capital but generate substandard returns on that incremented invested capital. The first category involves businesses where you don't need to reinvest much back into them each year, but they are still able to earn incredible returns. These are typically businesses with pricing power, and a business that can routinely put through price increases to customers usually possesses some sort of competitive advantage. The increase in prices drops through to the bottom line and is the best form of organic growth, given that it requires no reinvestment. REA is a good example of a business that falls in this category. The second category is still attractive from an investment standpoint and involves businesses that require a portion of their earnings to be reinvested in the business. These businesses might be growing their revenues and earnings through a combination of volume growth and price increases, whereby reinvestments must be made in, say, new plants and machinery to support the extra volumes. The third category of investments should be avoided. These businesses have material reinvestment requirements and fail to earn satisfactory returns on the earnings that are redeployed in the business. If you were to think of this business as a savings account at a bank, the third category would require a depositor to keep topping up their account with new funds, whilst at the same time earning a very low interest rate on those funds. For a business that earns a return on capital lower than its cost of capital, any growth will be value destructive for shareholders. It's something to keep in mind when considering investment opportunities. Thanks for watching, and don't forget to follow us on Facebook and Twitter.